Hello everybody, Nick McDonald here. Well, we've certainly had a wild ride these last few days in the markets. And we thought for the first time this justified coming back and doing a midweek update as compared to waiting till Monday for the update. So thanks very much for joining us. I hope that you find this useful. It's going to be a slightly longer video than usual because I have quite a lot to say. I have quite a bit to say off the charts just initially as well. So grab yourself a cup of tea or a coffee if you would like to and kick back and relax, and hopefully I can share some insights here with you that really help put some things into perspective and help you see some sensible ways to be trading these markets. So first things first, obviously we've had some big down moves, and one of the first things that your typical trader or investor does is go and look at what the press is saying. Now there's something I don't do too much. So personally I like to just follow my own trading, my own charts, and I don't like to get too wrapped up in what the press is saying. But there's two people out there who, when they speak, I like to listen. I don't necessarily do what they say, but I like to listen to what they've got to say. And one of those people is Warren Buffett, and one of those people is Jim Rogers. Now those two should need no introduction, and I'm sure you all know exactly who they are. If you don't, then of course you could just go and Google search and you'll find all sorts of information about them. But let's just have a look at what Jim Rogers has been saying in the press. And he said this in many places. I happen to be on the Economic Times website here. I just Googled it and just found the piece of information I was looking for, but he's been saying this all around the place. Headline here is US will continue to be downgraded over the next few years. I just highlighted some key text here. Everybody in the world knows that America is not a AAA rating. Everybody in the world knows America is the largest debtor nation in the history of the world and is getting better. Okay, so that's Rogers' advice. It is really bad, and America deserves to be downgraded. However, let's go and look at what probably the richest trader/investor in the world has to say. Warren Buffett. Here's an article from Bloomberg. Buffett says US debt should still be AAA rated. Buffett thinks the S&P is crazy, and if you go on to read some of what he's been saying, if anything, it's just changed his opinion of the S&P, not of the US government and the US credit situation. So who do we believe? What do we do here? Because we've got a situation where two of the most famous and successful traders and investors of our time have completely differing opinions. And that is a classic example of why I don't refer to the press, because there is always going to be different opinions out there. And I have my opinions, and you have your opinions, and they have their opinions. Here's the thing, right? Nobody knows where the market is going today or tomorrow. We really don't know. Nobody does. I want to tell you a little story, and I thought about putting the video on here, but I decided against it. I thought it might be slightly unprofessional going out for an exchange. But what I did on Monday for my own clients, this was literally this day right here at the start of this candle. I got my 2-year-old son, and I sat him down in front of my charts, and I recorded this on webcam. So I had him sitting on my lap, and I brought up 4 charts, and I said to him, right, where are these charts going? You tell me what's going to happen next. And I got him to look at the major stock markets, and he said down. I got him to look at gold, and he said up. I got him to look at crude oil, and he said down. And I got him to look at the dollar index, and he said down. The dollar index didn't really move, but the other 3 got absolutely hammered. They got absolutely smashed, and he was right, bang on the nose on every single one of them. Now, what did he do? We call this the 2-year-old test. What did he do? And it's an absolute true story. This was just Monday. All he did was look at the chart and he saw stocks are going down. I think they'll keep on going down. Gold's going up. I think it'll keep on going up. He looked at the charts. I've taught him to look at a chart and decide whether it's going up or down. Simple, right? Even a 2-year-old could do it. That's what he did on Monday. Now, of course, that story is just to illustrate a point that nobody knows where it's going. And we're just as good listening to a 2-year-old as we are listening to anybody else, because we just don't know what's going to happen next. So what is the key though? What is the real key to making money in these markets? Is starting to get around to the point. The key is to have some rules and to stick to the rules. Don't trade emotionally. The people that started selling out their stocks here and really pushing these markets down and closing positions are the ones that are trading emotionally, the people that are panicking. And for good reason a lot of the time. I remember back when I couldn't trade, when I was learning to trade, I traded emotionally too. And a lot of people that hold long-term stock portfolios, they're not really traders. So they haven't managed to control the emotions of market swings like this. So there's a lot of emotion which drives these markets down. There's also a lot of fear because we've had the US debt rating and perhaps it's not, really, is that going to impact on the earnings of US stocks? Not so much. In 2008, when we had, when those companies couldn't borrow money, I remember speaking to CEOs of companies who couldn't, 1, get money for themselves, i.e. they couldn't get finance on a new car or a new house, and 2, couldn't get finance for their company. that had a massive impact on how US companies and companies around the world, that was a global situation, that had a real impact on their earnings, how they could make money, and on their personal lives. And the same thing was happening with the journalists. The journalists were out there, and they couldn't get finance on a new house either. So what was happening? Everybody was talking about that. That was a big deal. It brought a lot of fear to the markets, and it had a genuine impact on stocks. Whereas now it's still quite different. The biggest news in the world, and this is still big news, but the biggest news in the world, certainly outside of America, it's not the markets, it's the London riots. And that puts some things into perspective for me. As big as that news is, the markets were by far the biggest news back in 2008. I'm convinced that in 2008, if the London riots had have occurred, that outside of London, the biggest news would have still been the global financial crisis. However, right now, the biggest news is the riots, even though these markets are falling like this. The reason is it's not as global, in my opinion, as it was before. How is it that Jim Rogers and Warren Buffett could have such different opinions? And I say stick to your rules, and you will do well. Well, Buffett and Rogers, I think, will probably both make money. Rogers even said he won't buy gold. He said he won't buy gold because one of his rules is he doesn't buy things when they're going up. He will buy gold if it dips. Buffett is out there buying stocks because his rule is to buy stocks when they dip. Buffett could be wrong in the next few weeks. Markets could fall a lot further, or he could be right in the next few weeks and markets could rally, and he could be making money quite quickly. The thing is, I think we could all be quite confident in the 10 or 20 year outlook that Buffett has. He's probably going to get that quite right. Those stocks will probably be worth a lot more in that kind of time horizon. I want to tell you one other quick story, right? I was speaking to a broker just this week, and when I was speaking to the broker, he was telling me how terrible it is, how all his clients are losing money. They're all ringing up at such a busy time. And we had a bit of a discussion about that. In fact, I got quite a heated discussion because I said to him, look, there's no reason they should be losing money except that they can't trade. I said to him, you are not a stockbroker, so your clients are not long-term holders of stock. Therefore, why should they really be losing money? This is volatility, it's movement. That's what we as traders want. And he said to me, Nick, I bet your clients aren't making money. And I said to him, look, I'll tell you, not all of them are. Of course they're not. I would never claim that. But a lot of them are because they have some simple rules and they stick to them. And one of the key things, right, I say this often, but the biggest difference for me between a professional trader and an amateur is that professionals focus on managing risk, amateurs focus on making money. And this market has helped me add another little phrase to that. Amateurs trade on emotion and they focus on making profit. Professionals trade based on rules and they focus on managing risk. That is massive, massive differences there between professionals and amateurs. What am I doing now? What am I teaching my clients to do? And getting to my point, what am I suggesting you do? I'm suggesting that you focus on managing your risk far more importantly than making money. That is one of the key things in this market. And then you have some simple rules and you stick to the rules. So let's get to the charts. The first thing I want to do is look at the monthly chart, because on the monthly chart we'd identified these key levels, right? One of the levels we'd identified was the 734 level, and one of them was 700. And I had at least one comment this week that, and it was actually completely true, it wasn't even a comment, it was a fact, that on the way down the market just ignored the levels, it just smashed straight through them. And this is a monthly chart, by the way. And it absolutely did. And if we look at this, it looks like it's still ignoring those levels, right? 700, we can look back at it, see it's quite key. 734, just looking at flat levels where price has been supported and resisted in the past. But let's come in and have a look at this a little bit differently and have a look at it on a daily chart. And I've got 700 marked in now. Look at 700, how actually we ignored it on the way down, although we did have a temporary bounce off it here, and then we came down and we fell through it, then we came back up and we found resistance right at 700 before falling again today. So these key levels are not just support when price is above them, they're also resistance when price is below them. That's what makes them a key level. Let's just zoom out a little bit, try and put this level into some perspective. Come back and look through here. This is just going back to 2010. Look at where price found resistance at 700, found support at 700. Look at where it broke up through 7, found support, broke back down through it, came up and found resistance before falling right down off that level. Let's scroll all the way back here, looking at the upper blue line there of 700. Coming all the way back here now into 2008. Look at how key, before the markets fell in 2008, look at how key 700 was. Look at how many times we found support there, and then we found resistance there, right on it on many occasions. Come all the way back into 2006 now. We're back into 2006 and 2005. Look at how many times price was finding support and resistance around that 700 level. So 700 is key, and it was key on the way down. We broke right through it because there was so much emotion and fear in the markets. We then came up. The market's slightly less erratic now, although still very, very wild. We came up and we found resistance there. This is our new level. This is our new key level. This is what I want to watch. Above that is going to be starting to show us good signs of markets going up. Below that is going to be bearish signs of markets continuing down. It's going to provide opportunities. It has done for many, many years, and 700 is the level, is the closest level right now to the market action. Let's look at the other level though. So that's the level for the upside that I'm watching. If we did get up through there, then I'm looking at where resistance is on the chart on the upside. So this is really key, up around 765. There's major resistance there. Old support becoming resistance, and if price gets up to that level, that's where we look for it to stop. On the downside though, where are we looking at? We'll look at 600. Look at 600 down here. All I'm looking for, right, is these flat levels. I just zoom out like this and look at where is the key level where price has been supported and resisted in the past. And 600 is major. Let's just scroll back through and have a look. Even all through here, this is 2008. We didn't quite get to 600, but we got close. Let's just keep on scrolling back on this chart. Remember, it's the lower blue line. Look at this, all the way back in 05. Right, the major low in 2005 was 600. The low here in 2004, 600. We had highs and lows all through there back in 2004. Now you might think I'm going back a long way, and I am. I've just gone back to 2004. But it's also been resistance and support in 2009 and 2010, and I expect it to do the exact same thing again in 2011. So I've got some rules, and my rules are on the higher time frames. I look at these major levels, and then I look for trading opportunities around those levels. I just want to show the dollar index for a second. I know this is a index market update, but those of you who follow all my videos and watched the dollar index ones on Monday, I said I was looking for the dollar index to come down and to test 7,400, and I'd be looking for a bounce off it because it was stuck in a range. Have a look at what happened here. This is this week's action. We came down, we got as low as 73.90, then we've rallied nearly 100 points straight off 74 straight up. What did I do there? Just traded a key level. That's it. I traded that one, I did it well, and I just traded a key level. Nothing else was there to do. And that's exactly what I'm doing on the Russell, as I'm just trading these key levels. The other purpose to this video was to talk about the aspect there of sticking to our rules. Now let me just show you a few trades that I've been taking. So one, for example, this is a trade I take, an intraday trade. This is an example of a trade I do, right? So the market has fallen. This is a 1 minute chart now for the Russell, and it's only yesterday or the day before. It's a couple of days old, but it's from this week. This is a trade I take. The market is falling. The market starts to pull back, right? So it's in a downtrend. I like to trade pullbacks. The market's moving down. It's pulling back. What I've done is I've drawn in a fib line from a high down to the low, and I'm looking to trade this retracement back in. We've got the 61.8% here and a pivot point and these old lows. I'm looking to get short on that level. Now that's one of my rules, and I trade it in a slow moving market and I trade it in a fast moving market. What happened here on this day? The Russell came back in. It hit that level. It fell about 100 ticks straight off it down to 645. I made some money. And you know what happened after that? It absolutely skyrocketed 500 ticks upwards. Now what did I do? I made some of that 100 ticks on the downside, and I made none of the 500 ticks on the upside. Why not? Because I don't have a crystal ball. I can't predict the future. All I can do is trade and stick to my rules, and I made some money out of that trade. Let me show you another example, because I have talked about the gaps, and I talked about them on the video just on Monday, about the gaps on the Russell. So let's come and just zoom out here and have a look at some of these gaps. So here is today's gap. In fact, I just want to zoom in a little bit. So here's today's gap. Yesterday, that was that big move up yesterday on the close. Had a gap down today, actually started to close part of the gap, but then came down and went sideways a lot of the day, tried again to close the gap, didn't close it. However, let's come back and look at, so there's my Fibonacci level, by the way. There's that, when I showed you that live screenshot, I still haven't removed my fib line. This is where I came up, got short, came down, 100 ticks, and then 500 ticks straight up. I made money on that bit, I made nothing on that bit, but I stuck to my rules and I profited from it. Here's the day before. This is one of the biggest gap closes in recent years on the Russell. A huge gap up, and this, by the way, made about something like 16 times more on this winning gap trade than I lost on the losing gap trade just today. So this is just an example of just sticking to the rules. I said this on Monday that I was going to be trading gap closes, and I got a beautiful one there. Stuck to my rules, made some really good money out of it. The day before as well, so the day I did the video, this is coming back to Monday. Now this gap didn't close, but what I always do is I scale out, and on this gap here, right, we'd moved from 690 all the way up to 705. That's a big move on the Russell, right? Under any normal circumstances, a really big move up. I scaled out and made really good money on that gap close. I would have made more if it had closed the full gap. As it happened, I got stopped out on some portion back down here, but I stuck to my rules and I made good money that day too. Just doing things I told you guys about Monday, just doing things that I do week in, week out, year in, year out, sticking to my rules, managing my risk. I have come out of this whole affair pretty well. I've come out making money, I've come out sticking to my rules, I've been focusing on trading on rules, focusing on managing risk, and I have not been focusing on emotions. I have not been getting carried away. It's so easy to wake up and go, oh my gosh, the Russell's down 10%, what am I going to do? Sorry, when I say wake up, it's because I'm in Auckland, New Zealand, so I miss the first part of the day and I trade the closing part of the US session. And sometimes you go, gosh, I've been missing out, I should have stayed up all night, I should have done this, I should have done that. The truth is, none of that is going to make you money. Thinking about what you should have done and what you could have done doesn't make money. Thinking about what you can do right now, having some rules, sticking to the rules and keeping focused on managing risk, that makes money. There's some real good money to be made out here right now. There's some really key levels that are worth watching here on the Russell and the dollar index, and there's still some really good money to be made. As traders, if you're a short-term trader like me, you want movement. We love this movement. It's giving me ample opportunity. All I'm doing is keeping my risk a little bit lower than usual, because typically my stop losses have to be much wider than usual as well, because the moves in the markets are just so big right now. So I hope that helps everybody, and I hope that puts some things into some perspective as to what is really happening out there and how a professional trader is trading this market. And we will be doing another update on Monday, and no doubt we'll have another couple of wild days for the next couple of days this week, and I'll report back on those couple of days and the outlook as of Monday. Happy trading all, have a wonderful few days and a wonderful weekend, and I'll speak to you soon.